is this as good as it gets? I mean, $1 trillion in inflows, record launches. It certainly feels like maybe we're at a top, maybe we're peaking. I don't know.
No, I actually think we're just getting started. And I mean, I've been in the industry for longer than I've cared to admit, and it's always been great years. Not always been great years, but it's always been gradually evolving. But I think we've gone through evolutions, right? Passive, smart beta, fixed income, and now active. And then with all of those combined, I really think this is the start, firstly, of the active ETF growth. And I think that's really contributed to the growth this year.
We saw how passive ETFs were eating mutual funds lunch over the last couple of years. But as you point out, active ETFs having a big moment here. Who are they taking market share from? From passive ETFs or from mutual funds?
So it's really interesting, right? Like I said, I've been in the business for a while, and we've all seen that chart of the growth of passive ETFs with the mirror image of the outflows of active mutual funds, right? And we all inferred, or at least I did, that, oh, investors want passive, right? But now the numbers are really showing us that they want the ETF wrapper. They want passive and active in the ETF wrapper. And I really think that's kind of where we're going right now.
Let's talk about this coming year. It's very possible they approve the ability for a mutual fund to just stick on an ETF share class, the way Vanguard has done for like 15 years. If that's approved, my take is that you will probably find some people switching over to the ETF, and the ETF could be used maybe to minimize capital gains for the mutual fund. But largely, I think this probably helps active ETFs also. What do you say?
Yeah, I mean, if it's approved, I think it'll definitely accelerate the launches. I think even if it's not approved, the active ETF launches, in my opinion, are probably set to accelerate anyway. I think it's just going to give it another boost. It's going to be if the share classes are approved, I think it's going to be the best case for all worlds.
So it's not just 401ks or anything like that. We're also talking about potentially endowments doing more of the same. Yukon, for instance, has now been, we have a Bloomberg story on it about how they are steadily decreasing their exposure to hedge funds and instead choosing to put some of that money into buffer ETFs, which of course uses options to minimize losses, but also cap the upside gains. How big of a moment is that?
I think it's a huge moment, right? But I think it's something to be expected, right? It's what the ETFs are revered for. They're revered for cost efficiency, then they're revered for liquidity, and they're revered for ease of use. And I think that's what we're seeing in this story. They're going away from the hedge fund, getting that same risk management strategy in the ETF wrapper at a cheaper cost with anonymity and more liquidity. So it's exactly why ETFs sort of have had that run over the past 30 years and why I think they're going to continue to run, because there's still so many white spaces to be taken up.